Alrighty, so we're going to go ahead and show you exactly what you're getting when you have a candlestick, what the entire process is, how to read it, and how to use it in your trading. So when you have a candlestick, it's either going to indicate what the direction of the candle is going, either up or down, and you can change the colors on your charts. My charts here are green for candles that move up and red for candles that move down. So let's take a look at a bearish candle first. A bearish candle means it's moving down. Bearish indicating a bear. Bear is negative price. So on a price that moves down, the top is the open. So this right here is your open. Okay? Now the bottom of the candle is the close. Okay, so we have the open and the close. Now the price has then moved all the way from when it opened down to here where it closed. And then let me go ahead and get my my little cursor here to figure out exactly where we're at. Let's see here, get my cursor, and you can see that in this particular candle it moved 36 pips. Okay, from open to close it was 36 pips. Now if you look over here to the side up or on the top left, you can see that it says odd USD H4. H4 means that it's a 4-hour Japanese candlestick, and the 4-hour is the time that has elapsed in this candle. So this candle was a total of 4 hours from top to bottom. Now, one other thing to note is that during the price of a candle we have the high and we also have the low. So this is the high and this is the low. And remember, I'm just refreshing here, this is the open and this is the close. Okay, so these are the main pieces of information in a candlestick. Really, if you want to think about what a candlestick actually is, it's just a period of price movement in any given period of time. Okay, so now let's go ahead and change this to a different time frame. Okay, so I'm just going to go ahead and switch this over, and now you can go ahead and look and you'll see that it's daily. So now we have the price, instead of a 4-hour measurement of price, we now have a daily measurement of price. So this candle went up or down during a 4-hour period. Okay, so, rather daily instead of 4-hour. Now I'm going to go ahead and switch it again, and we're going to go to 15-minute. Okay, so it's the same thing. The candles don't change. The only thing that changes is the amount of time where data is recorded for any given candle. So this bearish candle was 15 minutes. So let's go back, and I'm just going to show you this is a 15-minute. This is the open. This is the close. That's the high, and that's the low. And you want to get yourself familiar with candlesticks so that you can understand exactly how they function. Okay, now let's go ahead and take a look at a green candle, which is a bullish. So for this particular example, we're going to see that this is the open, and then the candle went upwards. This is the close. So it's green, and so that means that the price has gone up. So if we want to get a measurement of the price, we just grab here and take a look, and this in a 15-minute candle moved a total of 10 points. It moved 10 points during that period of time. Now this candle, you notice there's no tail, and that's because there's a little itty-bitty dot here. You might not be able to even see that, but that means that the price opened, and it opened at the low, and it continued going up the entire candle, and it closed at the high. So there are no tails on this particular candle right here. There are no tails at all, and the tail will indicate the high and the low, and so we can use those. We can use tails. Let me go ahead and look through the charts. We can go ahead and use tails to get some idea of what's happening for price action. Price action just basically means that price is changing in direction, and it gives us an idea of what the action is, what's happening with price. So for this example, you can see that the price was going down, and then it shot up. Okay, so what does that tell us? That tells us that the price here on the lows was rejected. And many times when you see a tail like this and the price moving upward, that is an indication of a good time to take an entry signal. So we'll take a look at this particular candle here. This is a green candle, so it opened right here. This blue line is the open. You see that? Now, what happened was the price started to go very low. Okay, so at the open of this candle, this was a red candle. It was fully red. And then it was rejected, and price ended up, and it closed green. So here's where it closed. No tail on top. So this is a straight rejection. And what we call this a pin bar. We call that a pin bar. Okay. Now what that means is that the price was rejected, and it is a good idea to be looking for potential upward moves. And as you can see in this particular setup, that would have worked just fine. So let's go ahead and find another example. Here's another one. Okay, this is a pin bar. This is a bearish pin bar. Now we'll draw it. The price opened right here, okay, and it started to crank up, and so we got a green bar. At this point, it's right now it's red, but when it was all the way up here, when the price was up here, it was green. See this level here? Traders were probably thinking, okay, it's breaking out, let's go long. Well, then all of a sudden the market had other ideas, and it tried to shake people out, and it started to go down. Okay, well then at that point it closed right here, so you could say, okay, we have ourselves a bearish pin bar. This might be a good short opportunity. And as you can see, it worked out pretty good. So, you know, in that case, we'll take a look here. A good place to put your stop loss would be right above this tail. You want to always think about putting your stop losses above and below the tails, and in this case it would have been a very nice trade. Now I'm finding some positive examples. Sometimes these trades do not work out. If you take a look right here, this would have been a pin bar, and this trade, actually this trade, let's see if we would have put our stop loss right here, it may or no, well, it may or may not have worked for you because it might have hit the stop here by spread, but it might have, you might have been able to hit your target down here if you had your target down there. So that might have been a good trade. If you didn't get out here, you definitely would have got stopped out right here, which is part of the reason why it was rejected here, is because people had their stops right there. So you can always want to try to remember where people are placing their stops. One other thing I want to show you, and this is the trading platform I'm using is called MT4, MetaTrader 4, and I'm going to show you how to use a data window on the MT4. Okay, so if you look over here, we have a data window, and you can see these numbers will be changing, and it basically gives you the information on each one of these candles. So let's take a look at this pin bar I was looking at earlier. You can see that it has the open time, which is 1600, and it's based on the time frame of your trading platform. It has the date, which on this particular candle we're looking at 2013, February 7th. The open price was 1.03297. The high was 1.3385, the low was 1.3255, and the close was 1.03268, and the volume was 1785. And there's a little bar on the toolbar. Let me drag my chart in just so you can see that. This little button right here is the data window, and you just push that button to get that information in your chart. And it can be useful if you're trying to do some back testing, or if you're trying to get some exact data on where you want your just trying to examine where your stop losses are and things like that. So let me just go ahead and show you. If we're looking at this candle, you can plot. Here is the open right there, and you go and look at that in the data window. You can find out what the price was. Here's the high, here is the low, and this is the close. Okay, so that is the basic understanding of how to read a candlestick. Now, I showed you the pin bar on the candlestick. Now, I want to also show you how to identify another trade setup that I like to do called an engulfing pattern. So let's go ahead and clear the screen, close this data window, and let's see if we can find an engulfing pattern. Let me zoom out a little bit. Okay, so let me go to the price here, and we can find an engulfing bar, and this is a pretty decent example right here that I just found. Okay, so let me get my pin back out, and you can see we have a channel here, okay, and we have this channel, and we have just flat sideways motion. I'm going to clear that little scribble out. Sorry. We got this sideways motion here. We got a channel, and then all of a sudden we get a green bar. This bar has out moved this bar right here. So that is what we call an engulfing bar, which means that it takes out the highs of the previous candle. And a lot of times that will be another signal. You get a candle like this will be a signal for further upward momentum. This actually isn't a good example, which is okay because now you get to see that not all of them work out, but a lot of times you will get an engulfing pattern, which means it's taking out the previous candle, the top of it, and that'll indicate some momentum. I like to look at these engulfing candles patterns when I'm trading. Here's a great example of one. I want to zoom up so I can show you guys exactly what it looks like. Okay, right here. Okay, so now we got it locked in. Now you see we have many red bars in a row here. Okay, so there's 1, 2, 3, 4, 5 red bars, and then all of a sudden you get this strong bullish candle. And I call them bars, but actually they're candles. It's incorrect terminology. They're all candles. They're not bars. A bar chart is extremely different. I will show you. Well, let me just go ahead and show you what a bar chart looks like. We'll stop that. And this is an actual bar chart. Much different than a candle. They are the same information. It's just displayed differently. I prefer candles because that was what I was trained on. Okay, enough of that. But if I call it a bar, I still mean candle. So we got 5 down in a row, and then all of a sudden this powerful green bar. And it's called engulfing because it covers this red bar fully, and it's breaking out of this top. So a lot of times when you see a bar like this, that will show you that we've got some more upward momentum. So when you would the way you would trade that is that you would put your stop loss at the bottom of that candle. Your entry, there's 2 ways to enter it. You could either enter as the price is breaking this level, or you could enter it on the close. Obviously, you're going to have a tighter stop loss if you enter on the break, and if you enter on the close. But take a look at this just to give you some idea of how candles move. You see that this broke right here. Now, if you would have got in and you would have put your stop too tight, and it came right back down to challenge this level that it broke. So this was an actual level. This was a resistance level. It broke the resistance level. The candle closed, and then what happened to price? It went right back down to this level. It triggered the stops, hit right back to the support, and then it came right back up again. A lot of times when you see a breakout, you will experience that the price will break, then retest, and then break again. And that's exactly what happened in this scenario. And that's why these tails exist, to whip people in and out of trades. So in this particular candle, you could have entered on this break, and you would have had a nice profit up here, or you could have entered on the close and put your stop down here. Either way, your stop would have been down here and it would have been safe with either one. But you can see obviously this one you would have got more points. It went up several more candles, and then if I zoom out it goes up even farther. But that is an example of what we call a bullish engulfing candle. A great pattern to trade. The exact same thing is the case if you're looking at bearish candles. Here's a bearish one. We've got green, mini green bars, or candles rather, and then all of a sudden we got this red candle. See, this was flat. You see that was a red candle. It was tried to break it, but it was kind of a fake out. Then we went red, green. Okay, but then this one here broke the level. It broke this body, and then it broke the tail, and then it closed. So your entry, if you want to enter on the close, which I personally do like to enter on closes, I do not enter on the actual price break because I wait for the candle to close because there's too many fake outs. In this candle, it would have been an entry here, a short trade, and you put your stop above here, and you've got yourself a nice entry. And the reason I wait is because if you look like here, take a look at this, there's a lot of fake outs. You see there's 1, 2, 3 candles. So if I would have entered in a short on this based on, or a breakout, a long rather, if I would have entered a long on a break of a level here, this tail whips up and whips right back down, and it fakes me out and reverses the other way. So you've got to always be remembering fake outs can always happen on Japanese candles. So in review, we talked about what is involved in a candle, how to read it, the high, the open and the close, and the low. I talked about the pin bars. I talked about some price action movement, some good entry strategies as far as using pin bars or tail candles. They call them pin bars or tail bars. Also, I talked about engulfing candles. And actually, there's a really good engulfing candle right here. I don't know if I already went over that, but right here you can see there's a good one as well. And one last type of candle that I'm going to show you is an inside bar. And an inside bar is another pattern that we can find that will help us determine entry points. So if we go through, I'm just going to draw here. We got a downward move. Okay, and then all of a sudden we got this green bar, and this green bar would be called an inside bar because it did not go over the top, but it's a green bar. So a lot of times we'll see if you go halfway here, you got this full candle, and then it goes half. That's called a green inside bar, and your entry would be right here, or your entry would be right here at this line, and your stop loss would be down here. And you can see that the price went up. Okay, so let's go ahead and see if we can find another inside bar. This would be an inside bar. Okay, we got an upward move, and this is not the greatest example because I'm just finding them here because I want to kind of show you that you can find them off of any chart. But this would have been an inside bar. Okay, right here. You can see you got an inside bar. It actually went sideways, and this particular pattern was sideways for a while before a breakout. So that's another good teaching moment here, is a lot of times you get a nice strong move, then you get sideways momentum, and then a breakout. So sometimes these inside bars will move and go in the direction of the trade, but then other times they will come into a sideways trading system. And then here's another one where you get a sideways trading market. And honestly, sideways markets are probably the most deadly thing for traders, is because you try to find a trade, you try to find a pin bar, a reversal, an inside bar, engulfing pattern, all of these things, and then all of a sudden you get hit with a sideways market and you can get chewed up and your stops can get tore up, which is what would have happened in this case. And honestly, learning to identify sideways markets and trading in sideways markets and avoid getting chewed up is another lesson that we're going to do. but I'm not going to handle that on this one, but I did think I would point it out to you while I was going over the trades. Okay, so let me go ahead and see if I can find another good example of an inside bar, and here we go. Okay, so we got a nice strong downward move. Okay, you can see that. And then we got an inside bar right here. Okay, and then this one ends up going up and making profit. Now, just another thing to note, here's an inside bar, and this is a fake inside bar. It's not a fake inside bar, but it's an inside bar, but it was not a winning trade. It ended up going right back down. So what that means is, do all these patterns work? No, obviously not. If they all worked every time, we would all be multi-million-dollar traders. But the key is to find a pattern you're good at identifying, one that has a good win rate, over 50%, a good risk to reward ratio, and that is what you will use to make yourself a profitable trader. Nothing is working 100% of the time. So this inside bar did not work, but this one did. So overall, you'd be 50% on these two examples. If your winner was bigger than your loser, which your loser here would have only been, 25 pips, and your winner here looks to be much more than that. So your winners are bigger than your losers. If you get 50%, then over time you're going to be a profitable trader. Okay, well that's it for the Japanese candlestick lesson. I hope you enjoyed that. If you have any question, please contact our training staff. We'll be glad to help you out. We're here to help you guys succeed. Thank you.